How could the escalating Middle East crisis potentially push the United States towards a massive economic crisis? This is a question that's been echoing in the halls of power and the minds of economists alike. The Middle East, a region often synonymous with conflict, is currently grappling with an escalating crisis. The economic instability is palpable, with the World Food Programme warning that more than half of Afghanistan's population is facing acute food insecurity. But it's not just about food. In Europe, economies are teetering on the brink, with rising inflation, energy crises, and political uncertainty casting long shadows over the future. A ripple effect is already being felt across the globe, and the United States is by no means an exception. As it stands, America finds itself in a precarious position, poised to fund two wars in the midst of this unrest. This move could not only fuel inflation, but could potentially be the last straw for the U.S. economy. The stakes are high, the consequences far-reaching, and as we delve deeper into this complex issue, it's clear that understanding the intricacies of this crisis is more important than ever before. The U.S. is not an island, its economy is intricately connected to the global marketplace. This is particularly true when it comes to the escalating crisis in the Middle East and its potential impacts on the American economy. Firstly, let's discuss inflation. As the U.S. funds two wars, it's not only pushing up defense spending, but it's also increasing demand for resources. This heightened demand, coupled with constrained supply due to the crisis, could lead to surging prices, a classic recipe for inflation. We've seen this happen before in the 70s during the Vietnam War, where inflation rates soared into double digits. Next, higher interest rates. To counteract inflation, the Federal Reserve may have no choice but to hike interest rates. This can have a ripple effect throughout the economy. For instance, higher interest rates mean borrowing becomes more expensive. This could discourage businesses from taking loans for investment, potentially slowing down economic growth. Then, there's the strain on resources. Funding wars is an expensive endeavor, one that can put a significant strain on the nation's coffers. As resources are diverted towards defense, this could lead to cuts in other areas like infrastructure, education, and healthcare, which are vital for long-term economic growth. Moreover, we can't ignore the potential impact on trade. The Middle East is a critical region for the global energy market. Any disruption to the supply of oil could send energy prices skyrocketing, which would further fuel inflation and put additional pressure on American consumers and businesses. In addition, the crisis could lead to increased geopolitical uncertainty. This can make investors nervous, leading them to pull out of riskier investments and flock towards safer assets. This could potentially lead to a slowdown in investment, further exacerbating the economic challenges. Finally, there are the potential impacts on the global economy. As seen in the recent crises in Europe and Asia, economic turmoil in one region can quickly spread to others. The U.S., with its deeply interconnected economy, is not immune to these effects. These factors are threatening to keep interest rates high for a prolonged period, which could break the real U.S. economy. Scene script. Interest rates are a crucial component of any economy, but what happens when they stay high for too long? In the simplest terms, interest rates are the cost of borrowing money. They play a vital role in managing the pace of an economy. When the economy is booming, central banks may raise interest rates to keep inflation in check. Conversely, in times of economic downturn, they might lower rates to stimulate spending and investment. Now let's bring the Middle East crisis into the picture. As the crisis escalates, the U.S. is moving to fund two wars. This situation is inherently inflationary. When a government increases its spending significantly, it can put upward pressure on prices, leading to inflation. In response to this inflationary pressure, central banks like the Federal Reserve may feel compelled to keep interest rates high. Why does this matter? Well, high interest rates can make borrowing more expensive for businesses and consumers alike. This can lead to reduced spending and investment, which can slow economic growth. If these rates remain high for an extended period, the impact can be even more severe. Leading economists, like those at the Federal Reserve, have voiced concerns about this very issue. They warn that prolonged high interest rates could lead to an economic slowdown or even a recession. If businesses cut back on investment due to high borrowing costs, it could lead to job losses and reduced consumer spending. Data also supports these concerns. Historical trends show that periods of high interest rates often precede economic downturns. For instance, before the economic recessions of the early 1980s and 2000s, the U.S. experienced prolonged periods of high interest rates. The longer these rates stay high, the greater the potential damage to the US economy. So, as we watch the situation in the Middle East unfold, it's essential to also keep an eye on the Federal Reserve and the decisions they make about interest rates. These decisions could have far-reaching implications for the health of the US economy. The potential consequences of this crisis are far-reaching and could affect every American. The domino effect of the ongoing Middle East crisis and the subsequent impact on the American economy can have serious implications. Firstly, let's consider the impact on consumer spending. With the US government funding two wars, inflation is bound to rise. This inflation will result in higher prices for everyday goods and services. The purchasing power of the average American decreases, leading to reduced consumer spending. Now, consumer spending makes up about 2/3 of the US economy, so any decrease in this spending could have a significant impact on economic growth. Secondly, the financial burden of two wars will undoubtedly increase the country's public debt. The US is already grappling with a high debt-to-GDP ratio, and any increase in this ratio could lead to a downgrade in the country's credit rating. This downgrade could make it more expensive for the government to borrow money, further exacerbating the economic crisis. Finally, and most importantly, there is the very real danger of a recession. A recession is a period of economic decline spread across the economy that occurs more often than you may think. During a recession, unemployment rates rise, household incomes stagnate or fall, and businesses stop growing. According to a survey of European fund managers, the majority expect a recession in the next year. While this is not a certainty, it is a possibility that cannot be ignored. It's also worth noting that the potential consequences extend beyond our borders. The global economy is interconnected, and a recession in the US could have a ripple effect, potentially causing economic downturns in other countries. The European economy, already facing its own challenges, could be particularly vulnerable. In conclusion, the potential consequences of this crisis are not just economic. They could affect the way we live, work, and even our future prospects. The impact of the Middle East crisis isn't just a problem for politicians and economists, it's a problem for every American. So what can be done to mitigate the potential economic fallout from the Middle East crisis? That is the million-dollar question. As we grapple with the complexities of this situation, it's important to think about strategies that could help us navigate these choppy economic waters. The first line of defense is diplomacy. Engaging in diplomatic efforts to de-escalate the Middle East crisis could lead to a reduction in conflict-induced spending. This could involve fostering dialogues, mediating between parties, and employing international pressure to encourage peaceful resolutions. It's a challenging path to tread, but history has shown us that diplomacy can often prevent economic disasters. Economic strategies are also crucial. Diversifying the economy, especially moving away from over-reliance on volatile sectors like oil, could be a game-changer. Investing in renewable energy sources, for example, could provide a stable alternative while also addressing environmental concerns. In terms of public policy changes, implementing reforms that foster economic resilience is key. This might include strengthening social safety nets to protect the most vulnerable from economic shocks and promoting fiscal responsibility to prevent excessive government debt. But what do the experts say? Economists suggest that maintaining open lines of communication with allies and trading partners could help to mitigate the impact. They also advocate for proactive monetary policy management, including careful handling of interest rates to balance the need for economic growth with the risks of inflation. To support these strategies, data is our friend. Monitoring economic indicators, tracking conflict developments, and analyzing trade patterns can provide the insights needed to make informed decisions. While there is no one-size-fits-all solution, a combination of these strategies could go a long way in mitigating the potential economic damage from the Middle East crisis. The road ahead may be rocky, but by employing a multifaceted approach that blends diplomacy, economic strategies, public policy changes, and data-driven decision-making, we stand a better chance of navigating the turbulence. While the situation is complex and challenging, there are steps that can be taken to mitigate the potential economic damage. This crisis, like all crises, presents an opportunity to learn, to adapt, and to build a more resilient economy for the future. The Middle East crisis is more than just a regional conflict, it's a global economic threat. The ripple effects of these geopolitical tensions are far-reaching, with the potential to impact economies around the globe, particularly the US economy. With America potentially having to fund 2 wars, the strain on the economy could be tremendous, possibly leading to a significant economic crisis. The role of interest rates in this scenario is crucial. Prolonged high interest rates, a necessary but potentially perilous response to such a crisis, could deal a heavy blow to the real U.S. economy. The implications of this could be severe, with the potential to disrupt economic stability and growth. It's essential, therefore, to explore and implement solutions that can mitigate these potential impacts. Whether it's diplomatic negotiations, economic strategies, or strategic alliances, proactive measures are necessary to navigate through these challenging times. As the situation in the Middle East continues to evolve, so too will its potential impact on the U.S. economy. It's crucial that we stay informed, prepared, and proactive.